This week, we're talking to the CEO of a company that helps retail investors, Canadian ordinary investors, make sense of private products. So, getting access to things that you might not have gotten access to before and putting them into a portfolio in a way that makes sense for you. There are pros, there are cons. We're going to talk about all of that so that you can make a better wealth decision for yourself. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. Greetings. My guest this week is Nimmer Bugnush. He is the co-founder and CEO of Toronto-based private asset management firm called Obsido. And Obsido is a firm that helps people navigate and invest across a variety of private asset classes. Nimmer, how are you today?
I'm very well, John. Thank you very much for having me on.
It's a pleasure. I've been wanting to talk to you on this platform for a while. People listening might not know this, but I was asking Nimmer to perhaps be a guest some time ago, and we finally got around to getting it done. So let's see if we can start by talking about private assets just in a very generic sense. Why would people want to invest in private markets in general?
Yeah, I think, John, my view is first and foremost that private markets are not for everyone. I will be, while I am the founder of a private market investment firm, I will acknowledge that this is a complex ecosystem where you do definitely need access to resources and expertise before you can really make a move. But in terms of the why, I'll say that there are several reasons. I think the top reasons include diversification, return enhancement, income enhancement. That said, there's always a trade-off. And I think the main trade-off within private markets is in order to access these characteristics, you're giving up on liquidity, you're giving up on transparency. And these are trade-offs that are, part of the discussion of being able to sort of make a decision to go into this ecosystem. The larger comment I'll make is if you step back and you think about the evolution of global capital markets, right? Historically, the end goal for companies of every size was to really find a way to IPO and to become a public company. Over the last, call it 20 odd years, as more and more capital has mobilized into private markets, we've simply seen an evolution of value creation and value realization across capital markets where private markets are playing more of a role than they've ever played before. So historically, it may have been fringe companies, fringe sectors, very, very early stages, companies that were sort of beneficiaries of private capital. But today, we're in a world where private capital competes head to head with, call it traditional or legacy sources of capital, such as banks, in terms of extending equity financing or debt capital to companies of effectively every size. And so, from my perspective, I would simply say that one, if private markets is suitable for the specific individual or corporation or company that's looking at making an allocation, you then have to kind of consider what parts of private markets to potentially invest in, what objectives are you looking to accomplish? And there's a lot that goes into that. But I digress. I'll pause there. Hopefully that gives you a sense of at least my perspective.
Sure. So one of the things that I have noticed is that there's a growing amount of acceptance, even though there is also some hesitancy with regard to private assets. The thing that I always like to point out is that the major pension plans, if you look at what's going on in, Hoop and Omers and teachers and certainly the Canada pension plan, they've always had a significant exposure to private assets. I would say always at least 20%, and sometimes, and in some certain instances, over 50% in private assets. And for the people who think, well, this is new, my rejoinder is actually it's not new. It's just retail investment is now just beginning to catch up to what's been going on the institutional side for literally generations. Do you have any thoughts about the way things are playing out in a macro sense?
Yeah, no, I mean, listen, at the end of the day, if you are employed and you're contributing to the CPP, you are at some point going to be a beneficiary of a portfolio that is comprised of a large allocation to private assets. And if you're an employee of the healthcare, system within the country, similar story, right? So I completely agree with that. I think we are, as you typically see in markets more generally, structural innovation over time unlocks access and really we are at the beginning of structural innovation that is allowing smaller investors to potentially participate in this ecosystem. That said, it's not just about participation. You have to pick the right managers, the right strategies. You have to be thoughtful about asset allocation. Only then do you truly unlock the benefits of the space.
Okay. All right. So let's talk about one of the elephants in the room, and that is that there have been a few instances in 2025 where some fairly prominent private asset firms in Canada have put up a gate, which is to say they have restricted the ability to gain liquidity, and products that you might already have to wait 1 to 3 months to get out of, you can't get out of until such time that the gate is lifted, and that could be 2 or 3 or 4 quarters down the road. We've talked about this before. Liquidity is one of the constraints of private assets. It's I call it a feature, not a bug. But I'm wondering what your thoughts are with regard to the fact that it's been going on and the fact that it might continue to go on. And in fact, it might even become more prominent in 2026, depending on what goes on in the wider economy.
Yeah, listen, I think that first and foremost, I think folks that are listening into this podcast should generally become familiar with the concept of liquidity risk within private markets, the concept of the liquidity mismatch between the assets of a portfolio and the redemption terms that are being made available for that fund. I think in terms of the gating situations that we've seen, generally speaking, they have been somewhat isolated to the real estate market that has sort of suffered from stresses over the last several odd years. I think beyond that, if you start to think about some of these issuers that have had challenges raising gates, first and foremost, John, and I know you know this very well, the gating is really protection for investors that are remaining within the fund that are not looking to exit to avoid a fire sale of assets or distressed sale of underlying securities at a deep discount. So to some extent, I empathize and I understand why the gates have been, put up. But that said, I also think, frankly, it's a learning experience for a lot of investors that are going through this right now, that you really want to be thoughtful about, one, what part of your, call it client's capital is being put to work within these structures. It really should be capital that is not needed for a long period of time. Two, are you building a portfolio that is diversified by asset class and sector within private markets so that you're not necessarily over concentrated to one particular macroeconomic theme or sector such as real estate? So if you have sort of a nice mix of underlying asset classes, that helps to basically mitigate some of the cyclical risk that impacts one asset class over another. So those are just some of my points of feedback. I don't feel equipped to comment specifically on an individual fund, but I'm not asking you to. Yeah, I will sort of say that as a general rule, when you're conducting diligence within private markets, paying attention to the governance structures of a given fund is really, really important. And that encompasses the manager's approach to redemption, liquidity risk. Have they had gating issues in the past? How have they come out of those issues? These are all things that should make up part of the diligence when you're putting capital to work. So I think a great learning moment for a lot of people. I do empathize with those folks that are caught up in this mix, and it will clear up over time. But some great lessons coming out of this process.
Let's talk about two of the main asset classes in the private space. That's private equity and private debt. Want to see if I can have you weigh in on the pros and cons of each, and specifically in the context of 2026. Let's start with private equity. What do you see as being the macro framework and environment for private equity in 2026?
Well, I think we're coming out of an environment where, we were basically operating in a close to zero interest rate environment for a long, long period of time. That pushed up entry sort of multiples or purchase price multiples within the asset class. I think if you think about the vintages, so call it 2020 to 2022 or so, a lot of things were put into portfolios at a very high entry price. And today, if you look across the clearing price for those types of assets, we're talking about entry prices that are actually higher than the clearing price for a lot of those types of assets. So I think GPs have some difficult choices to make where they do have a lot of those assets within their portfolios. But on a go-forward basis, I think it's a really attractive time to enter private equity as an asset class. There has been a significant reset that's taken place within the context of sort of the prices being paid to acquire different portfolio companies within different sectors. You do have a pretty robust and growing secondary market that provides another entry point for investors to potentially access, call it the buyout market, the growth equity market, et cetera. And then you have some really, really interesting secular tailwind that could potentially create some really interesting new private companies. AI would be a great example. We've seen some very significant private companies emerge and see some very significant value creation within private markets. And you can expose yourself to those types of themes within private equity. So I would say, we are an allocator. We continue to put capital to work within the private equity ecosystem, irrespective of what's happening from a vintage year to vintage year basis. But I would say that this is certainly an interesting and attractive entry point for investors looking at that space.
Okay, and just so, because a lot of the people that are listening today might not be as sophisticated as people like you. So when you say GP, you mean the general partner, the person who's the firm that's actually putting the product out into the marketplace, so that
That's right.
people understand what it is we're talking about. Let's see if we can move on to private debt now. So you've offered your thoughts on people who are buying private companies. What about people who do private financing so that they can expand their companies or grow or do whatever? What are your thoughts on private debt?
Yeah, I think the top end of private credit market, call it corporate direct lending, that is a space that continues to attract a lot of capital on the institutional side, on the retail side. As a result, I think you are seeing an increased competition to lend to companies that are sort of at that scale. And so you will see, just by virtue of the supply-demand dynamics, that there is going to be sort of a slightly lower forecasted forward return for that segment of the private credit market. That said, if you come down the spectrum to the middle market, the lower middle market, those are still extremely attractive sort of spaces from a premium return experience, be that against corporate direct lending or even against high yield or broadly syndicated loans. You are seeing still very attractive spreads lending into that, call it lower middle market opportunity set where capital is just not so broadly available. So I would say that's certainly an area where we're sort of spending some time. And then beyond that, there is also a secondary market emerging for private credit. It's very early stage relative to private equity. And so there might be an opportunity to potentially enter private credit without compromising credit quality through a secondary structure, take advantage of some of the discounts that you can take advantage of within that structure to enhance the overall return. So that's something else that we're just paying attention to that people may want to spend some time evaluating.
Okay, so we've now talked about the elephant in the room, the gating, the two main asset classes, private equity and private debt. We've also talked about real estate. I'd like to take a moment, if we could, please, to talk about the structure that has become, I would call it the dominant structure of the contemporary era, and which is something which is allowing for a moderate amount of liquidity. So we'll call it an evergreen structure. In the old days, when you put money into a private asset class, you literally had to wait years before you could access the money. Retail investors are used to T+1. If they sell a stock, a bond, a mutual fund, exchange traded fund, they get the money the next day. So we're trying to find a midway point between get your money tomorrow and get your money in a few years. And many, many products are now coming out that are offering access to private asset classes with what I'm going to call an evergreen structure, where you can get access, let's say quarterly, every 90 days or so. What are your thoughts about that?
Listen, I think that, frankly, if I zoom out, I think that this is a net benefit for private markets, broadly speaking. I do fully appreciate that this certainly creates a more useful entry point for retail capital. Check sizes are smaller, capital gets deployed right away. You do have the inter-year liquidity aspect as well. But interestingly, you're actually seeing a lot more institutional capital flow into these vehicles as well, recognizing that operationally speaking, it's a lot simpler to allocate through an evergreen structure than the legacy structures that you were just mentioning, right? Because if you rewind the clock here, the operational structure of investing through a closed-end vintage year vehicle, you make a commitment, your capital might get called over 6 months, 12 months. It could take a long time for that capital to be called. So you need to think about your cash management in between that capital being called. Then to your point, that capital is then within that vehicle for a minimum 10 years. Typically there's a 2 to 3 to 5 year extension period that might be employed. So it creates a lot of operational complexity, even for very large organizations. So I think that there seems to be a recognition across institutional capital, retail capital, that these structures just make it simpler to invest within private markets. Then you have the other side of the equation, which is the investment thesis around evergreen structure. And this is sort of an interesting intellectual exercise, right? So historically, in a closed-end structure, you had your sort of different segments of the life of a given vehicle. You had the period where capital was called, then it was deployed into underlying deals. Then there was a harvesting period where capital was then extracted. And then there was a realization where that capital was returned to the end investor. But typically speaking, there was 4 to 6 years where the general partner, the fund manager, had the ability to basically put capital to work, value create, figure out ways to increase the value of those underlying positions, and then turn around, sell those positions, and generate realizations. With an evergreen structure, you're talking about really a perpetual pool of capital. So you're not really on that same clock, so to speak, as an investment professional, where you're sort of having to really rush the process of enhancing the value of the securities that you invest in. And listen, as an investment professional, I would say that that's a positive, right? Like, we know that time horizon is one of the most significant indicators of return. You only have to look as far as Berkshire Hathaway, right? Typical hold period, 20 plus years within their structure. And you can sort of see the value of having time to be able to basically put in place value creation and enhancement. So I think that over time, the evergreen structure will actually alter the way that private markets sort of invest capital, the way they create value within the company's holding period. And ultimately, that'll be to the benefit of investors, to the companies that they invest in, and the overall broad-based economy. I know I'm speaking here sort of very philosophically, but I do think that we are at the entry point of a changing universe for this space. So long story short, I'm in favor of these structures. I think that their pros outweigh their cons, and there are cons, no question about it. But I actually think that they are a net benefit to investment activity, liquidity, operational sort of infrastructure, et cetera. So I'll stop there.
One of the things that I will say to add is that the financial services industry, the investment industry in particular, always counsels people to take a long-term view. And it strikes me as being disingenuous to, on the one hand, tell retail investors to take a long-term view and then recommend only products that can be sold the next day, when there are other products that might be as good or better, certainly can diversify and get you better long-term risk-adjusted returns, but you might have to wait 90 days to get the money out. And they say, well, that 90-day wait period is disqualifying. Well, wait a minute. If you spent your entire life telling people to take a long-term view, what's 90 days if your investment time horizon is measured in decades? It's not really a relevant consideration.
Completely agreed. Over-indexing to liquidity, I think, to your point, could create suboptimal portfolios or lead to suboptimal investment decisions, for sure.
Good. Okay, good. That's my point. I don't want to put too fine a point on it, but I think it's a fair point. All right, so let's see if we can wrap this up, Nimmer. The podcast is called Make Better Wealth Decisions. So you're in a unique situation. You're the CEO of a company that helps people with navigating the world of private assets in Canada. What advice would you give to listeners today to help them make better wealth decisions?
I would say that, we live in a world increasingly where the speed of information is becoming frenetic, right? The headlines you see on a daily basis are moving markets. Recently, John, I saw something almost comical, to be honest with you. It was a company that was formerly a karaoke company that has pivoted into logistics. And they announced or tweeted about a logistics AI tool that resulted in a $15 billion sell down in legacy public market logistics companies. I mean, it's just a comical situation that sort of took place, right? So I would say that as much as you can, try to disconnect from the day-to-day noise of, headlines, trust in the quality of your portfolio, try to make longer-term decisions. Whether you invest in privates or publics, just try to pull yourself away from the, finger on the trigger as a result of the latest, fear mongering from mainstream media. That would be my advice. I think that's all I can sort of say at this time.
Wise and measured, and much appreciated. Nimar, I want to thank you for your time today. It's been a real pleasure.
Thank you for having me, John. Great to see you.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.